Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site desk, we have Maddie Radner, director on Nasdaq's market intelligence desk. We'll also be bringing in Brian Joyce, managing director on Nasdaq's market intelligence desk, for a technical read on the charts. Maddie, it's great to see you as always. Welcome back to Trade Talks. And we got the Fed meeting out of the way. Not too many surprises. Market definitely took it in stride.
Yeah, to me, honestly, yesterday's meeting felt almost like a copy and paste of what we've been talking about since January. The Fed reiterated that rate cuts are coming. They're still anticipating 3 by the end of the year. Going into the meeting, there was a little bit of worry after some of the stickier inflation that we've been seeing that maybe the Fed would dial back rate cuts, but for now, they're sticking to the same narrative. They emphasize that the path towards 2% might be a little bit bumpy, but all is the same for now.
Yeah, I mean, if you look at their economic projections, they're looking at growth basically everywhere.
Yeah, so the summary of economic projections was pretty interesting. They're seeing core inflation peak this year at 2.6%, but then by 2026, they're ultimately projecting it to be at that 2% rate. They're seeing employment remain strong through 2026. And then finally, what really stands out to me is they're seeing the economy expected to grow 2.1% this year, which is up from 1.4 projected in December.
Yeah, I mean, it really is quite remarkable how this recession never materialized. The economy continues to grow. You're essentially employed if you want to be employed. And it really has led to a broad-based rally, right? At the end of the year, it was kind of predicated, we'll get these 6 rate cuts, never happened, maybe 3 this year. And, you know, we're looking at all-time highs.
Yeah, I think the narrative of keeping the 3 rate cuts on the table naturally pushed stocks higher and yields lower yesterday. We saw a broad-based rally heading into the close. S&P closed at fresh all-time highs yesterday. All 11 sectors within the Russell 2000 closed up, including some of the sectors that have been under pressure. So small cap financials, materials, industrials, and real estate all closed up 2 to 3%, which was very impressive. Microcaps actually were the leading group yesterday in terms of performance. So it is seeming like there is a little bit of rotation that's continuing to happen, and the breadth of the marketplace is continuing to improve.
All right, well, and perfect segue for Brian. So let's bring in Brian Joyce, our managing director on Nasdaq's market intelligence desk, for a technical read on the S&P 500. You know, Brian, to Maddie's point, making all-time highs. So let's take a look at the S&P 500 versus its equal weight.
Certainly. So we could see that this here right now we're looking at, if that's on your screen now, the weekly period chart S&P 500, and it's really since mid to late January has been making new all-time highs, which were previously set back in January 22. So we're about 9% higher above that top from 2 years ago. Whereas if we look at the equal weight index, because it's not putting a greater weighting on those larger cap tech names that have really been driving performance, particularly over the first half of 23, we can see it's just beginning now to break out from its prior highs for around the same time from early 22. So equal weight has a very similar looking pattern to it as the S&P 500, but it's just not, right there with it. So it's kind of dragging along from behind, so to speak. So if we see that rotation into these underperforming groups, like say, more broadly speaking, value, which is also now, convincingly making breakouts to all-time highs, I think, we could see equal weight closing that performance gap.
So, Brian, it sounds as if, breadth is improving, but it's not really there yet.
I think breadth is there, and I just don't think we have the outperformance in some of these other sectors. So really, outside of technology, communications, and maybe discretionary, when you look at any of the other remaining 8 sectors or so, let's talk about the S&P 500, the 11 main gig sectors. The remaining 8 sectors versus the S&P 500, none of them are looking all that great, because you're comparing them to these high-flying growth names that have such a strong weighting that would just, when you're looking at performance, it's just hard to compare the two. So on a relative performance basis, the comparison is not there, but the breadth, I think, is there. We're seeing the S&P mid-cap index right here. That's breaking out to new all-time highs as well. So that wouldn't be happening if there wasn't good breadth there. It's just not performing as strong as, say, the weighted indices that are really capturing a lot of that tech move into AI and everything accordingly.
All right, Brian, we'll be back to you in just a moment here. Maddie, let's talk about the strong consumer interest in new homes. It's not even just a seasonal trade, so it really depends what side of the fence you're sitting on, right? If you're looking to sell, if you're looking to buy, it's just super tight in that market.
Yes, so what I've been hearing is that the housing market is truly a supply and demand issue right now. We're seeing strong consumer interest in new homes, but the supply just isn't meeting the expectation right now. I think more recently, post-COVID, there's been a kind of a secular trend driven by demographics. So we're seeing millennials start to make moves, and maybe they were living in a city over COVID, or maybe living at a different home, and they're finally ready to buy a house. So we're seeing them kind of migrate out of cities looking at new homes, but the supply again is just not there. We were hoping that given the lower rates coming up, that will help sort of this issue, but on your panel this morning, a lot of the experts were kind of talking about demand will really outstrip supply for the next couple of years, most likely.
Yeah, that's a good point that you brought up, and I did want to reference the panel because we are actually historically in a normal interest rate environment. It's just the dynamics of zero interest rates and so much liquidity in the system, and and the different demographic dynamics. It's not like as if it's a bad environment. It's just there's no supply.
Yes.
To your point, which I know it sounds a little bit depressing, especially people in your age bracket that are starting to think about it. But the fact of the matter is, it's not as if the market is broken or it's an interest rate story, right? And I think that's kind of the silver lining to it. So with that said, Brian, let's bring you back in here. Let's take a look at the ITB ETF, right, which is the home builders, and it's been a good market for the home builders.
It certainly has. So, off of the COVID lows, this ETF is up over 400%, calling 413%. And just from 2022 lows, we're up 140%. So we could see the prior highs, the cycle highs post-COVID were set in December 21. We did make new highs last year in August of 23. So that was one of the first groups that really was able to break out to new highs. And so that's impressive alone, particularly since that was during an environment where we're just coming off the last rate hike. So, and as we know, housing very sensitive to interest rates. But as Maddie noted, demand has just been so strong and supply is lacking. And so we saw, with yesterday's announcement, we've seen some strength. The ITB's up 2% today. It was up strong yesterday, breaking out again to new all-time highs. So just, an example here of where something hits overbought conditions throughout 2023, late 23, and it's all throughout the first quarter of 2024, and just remains in that overbought kind of territory. So that's certainly bullish price action. It's hard to kind of pick a top here or guess when's a good entry point, but home builders have been strong for quite some time, really since coming out of COVID. They've been a leader amongst all industries, and you can compare them up to the semiconductor industry. Those ETFs tracking those names. That's how strong home builders have been.
All right, Brian, appreciate the technical insight as always. Thanks for joining us. And Maddie, I kind of want to end it on somewhat of a positive note here. One of the guests on the panel was a home builder, and he had mentioned that they're actually offering less incentives because interest rates are coming down. So it's almost like now is the time, if you are able to do it, especially with new home builders, because you want to get in while those incentives are there. So to your point earlier, it's not necessarily the interest rate story. It's just a matter of being able to find something.
And some of the people that have been sitting, waiting to sell their homes, looking for a new home, maybe they'll finally put their house on the market. We'll see.
We hope so. My fingers are crossed for you, my millennial friend. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.